I just got through signing loan docs on my own personal line of credit, also known as a home equity line of credit. And for those of you who don't know, this is a great way to access capital right now while equity is at an all-time high in America. So for those of you who own property, maybe you have a low 2-3% interest rate, don't refinance that, just pull out a home equity line of credit. Now, how does that work? When you get a home equity line of credit, you only pay payments similar to a credit card on what you use. So if you get a line for $100,000, but you only use $10,000, you only make payments on $10,000. One of the greatest things about a home equity line of credit is actually the term. So it's good for, you're making payments for 30 years, right? Which some of you might be like, oh, 30 years, why would I do that when I could just pay off a credit card in 2 to 5 or what have you. If you make the minimum payment on a credit card, you'll be paying that thing for estimated 5 to 10 years if you're just making the minimum payments. Some balances could go as long as 30 years plus if you're just making the minimum payment. So when you get something like a home equity line of credit that's stretched out over 30 years, if you're still making the same payment that you would have been making on your credit card, most of this debt can be paid off within 2 to 5 years. So it's because of that long term that most of your principal and interest, most of your principal really, if you pay above the minimum payment, is going towards the actual principal. Versus with a lot of these minimum payments, most of that is just interest that you're paying on. You're not really paying down your principal balance on most credit cards, at least not significantly. So I took a look at my personal debt, which I'm up to about $66,000, credit cards, car note, all kind of things, and consolidated it all, okay? Right now I'm paying $1,800 a month. That's taking me down to about $600 a month, okay? Now, my plan is not to pay $600 a month for 30 years. That's a little crazy. You have to be financially savvy when it comes to these types of things. So I plan on paying about $1,800 a month, similar to what I was already paying. But if I would have kept paying what I'm currently paying, I'd have been paying it off for 10 years. Versus consolidating it, I'm able to pay it off within 3.72 years, which is a little over 3.5 years, okay? So, Carlden Lainfiesta, the Mortgage Fiesta, I'm not telling you to get a home equity line of credit because it's more debt. I'm telling it to you so you could be more financially savvy. This economy, store closures, job layoffs, it's good to have that additional cash if you need it. It's never okay to really take out money if you don't have money to survive. That's not really what this is supposed to be used for. I personally am consolidating debt. I'm also building an ADU, so it's a good financial tool to help you make money or save money, in which case I'm trying to do both. Hit me up if you need me.